Hello, everyone, and welcome. It's Tom here. I'll just give everyone, some of our latecomers, perhaps just a couple of minutes to drop in. Perhaps 1 minute. I'll start the presentation shortly. All right, everyone, shall we get started? Hello, first off, my name is Tom. As I mentioned, I'm a senior industry analyst at IBISWorld. Thank you all for joining me today. We'll be going through a presentation, hopefully for about half an hour if I don't prattle on for too long, and we'll be covering off, to start with, an economic overview. We'll do this through the lens of some of IBISWorld's key external drivers to look at what's been going on over the past year, as well as a look forward to the year ahead. We'll keep our outlook going into the second section, where we'll look at some sectors that are likely to perform well and some that might face some headwinds over the coming year. We'll cover off some other topics as well. This was going to be, I guess, when we send out the itinerary, a real strong look forward into sort of the post-COVID economic environment, but given the recent changes with lockdowns, thought I'd change it to something a bit more topical, look at the effect that these lockdowns have on state and federal, the economic situation. We'll touch on inflation, as well as some, it will still include the changes to the economy and to the way that we work, as is, in light of the COVID-19 pandemic. So let's jump in, and we'll start at the top with GDP growth as our headline economic figure. And GDP has rebounded really well. From the results we have in the previous financial year, so 2020-21, 3 quarters of consecutive strong growth have been reported. And I guess from the results that we have so far, households and governments, particularly through consumption expenditure, have been driving Australia's economic recovery from the COVID-19 recession. We'll touch on some of the factors behind GDP a bit more in the coming slides, but in a broad sense for now, the economic recovery is beginning to shift toward being a business-led recovery, so shifting from households and government more toward the corporate sector. For instance, private capital investment grew by more than 5% in the most recent release of the national accounts, which is a really strong result. IBISWorld expects GDP growth to taper off a bit, but remain in positive territory, just as household consumption and government consumption slows. Just on these numbers on screen here, IBISWorld's GDP growth measure is in average annual terms, so I guess in percentage. In percentage terms, it draws the reported decline into the financial year coming, but I guess in quarterly terms, which is probably the measure you're more familiar with in the media, in quarterly terms, growth is likely just to slow a bit. And we'll touch on the effect of, specifically lockdowns on GDP a little bit later. In good news, the national unemployment rate has already fallen to below the benchmark set at the onset of the COVID-19 pandemic. So it was just over 5% pre-COVID-19. The unemployment rate then went on to peak at 7.4% in July 2020. Thereafter, it's fallen pretty much every month by 1, now to a low of 4.9% in our most recent results, and that's June 2021. That is the lowest unemployment's been for over a decade, which is, a good sign for the strength of the Australian economy and in particular the labour market. For the year ahead, unemployment is likely to trend slightly downward in monthly terms. The current lockdowns are expected to cause a moderate jump in unemployment, but this rise will likely be restricted by income support and business support packages. And in particular, these measures should allow unemployment and the economy in a broader sense to bounce back reasonably strongly. Again, just on the numbers, we're looking at average annual results here on the left. So although the reported decline is drawn a lot into the financial year ahead, I guess what we might consider monthly terms, if we look into the year ahead, the declines should be modest, as we've done a lot of, I guess, what we might call the easy lifting so far. Importantly, let's have a look at how Australia has been faring, I guess, compared to comparable economies, and the results show that we're doing pretty well. And Australia is joined by Japan, New Zealand, and Poland as a list of the only major economies that have already recovered to pre-pandemic employment totals. So I guess what's the takeaway? What responses to the COVID-19 pandemic have generated the best labour market results? There isn't a hard and fast rule to be applied here. So Australia and New Zealand, for instance, have been, I guess, world leading at limiting COVID-19 case numbers, but so have Iceland and Israel, which, as you can see on the graph on the right there, they're projected to have the longest period of recovery in terms of their labour market. So while there is a correlation between what we might call superior health outcomes and labour market recovery, this isn't the only determining factor. A broader economic scope appears to aid labour market recovery as well. So if we're looking at smaller countries with smaller populations and less diversified labour markets, there is a bit of delay, or I guess a prolonged recovery in labour markets. In addition, income support packages have proven to greatly aid a bounce back in job numbers. Australia and New Zealand both provided strong proportionate responses, proportionate to, COVID-19 case numbers. And I think the mechanism of these labour support packages has an impact as well. So if we look at the United States, they're projected to take another year and a half to fully recover in labour market terms. So they've had abundant stimulus, and there's a lot of heat in the US economy. That overall economic situation is really rapid growth, albeit from a lower base. So these stimulus checks have really boosted the US economy, but the mechanism in Australia was different in that JobKeeper in particular really kept that employee-employer connection going, while in the US it's been direct from government to households. So that connection between employee and employer, not quite there, which in terms of the labour market is going to prolong the recovery despite the United States having really strong economic growth at the moment. Disposable income and household consumption is two key drivers for the economy. Household consumption still is the majority of GDP. So what happens here is really important to the overall economic picture. In terms of how these two drivers have moved over the past 2 decades, essentially moved in unison. However, that changed in late 2019-20. So while lockdowns restricted expenditure, we had affected workforces on income support, so that's JobKeeper and JobSeeker at an elevated rate. And such was the scale of these schemes, disposable income actually accelerated despite us being in a recession at the time. With that, combined, the disposable income growing, consumption falling, the net effect of that is, of course, a really strong surge in the savings rate, which spiked to a 3-decade high. So what does that mean moving forward? Households, in good news, households have so far demonstrated a willingness to draw on savings. So the savings rate has been steadily declining since the peak in late 2019-20, and that's expected to drive up household consumption expenditure, which is forecast to grow at a solid 4% over the year ahead. So when you couple increased savings with what's reasonably strong growth in disposable income, so I think importantly, hours worked is going to pick up especially among part-time workers in industries and sectors such as store-based retail, food services, accommodation, entertainment, arts and recreation, and that is expected to benefit B2C industries over the year ahead. However, immigration to Australia has been negligible during the COVID-19 pandemic. That's going to result in weak population growth over a year ahead and just dampen consumption and income growth. The recovery in household consumption expenditure has been supported by a significant increase in consumer sentiment. From its low in late 2019-20, it's rose to a peak of 118.8 index points in April 2021. Again, that was a decade high. So how did this come about? Increases in social assistance benefits certainly helped by supporting the finances of many Australians during lockdowns, and in particular, lower income households or lower net worth households. We've also seen strong residential property price growth. It's been giving Australians a lot of optimism for financial, or more specifically, wealth optimism. And just generally, the Australian economy has outperformed many of the dire expectations, which we were set out during the really early stages of the COVID-19 pandemic. One thing to note, the surge in consumer confidence, I guess, post the downturn is not unprecedented. In fact, it's quite common. You'll see after the GFC, consumer sentiment spiked to above 110 index points, which is a really solid result. So corrections typically happen thereafter. So therefore, IBISWorld has forecast consumer sentiment to moderate slightly over the year ahead. We've already seen that, in fact, in May and June results, with a slight tapering off from the April high. Nevertheless, broad and mostly positive economic conditions is expected to result in consumer confidence remaining in positive territory. There are some headwinds, such as if the vaccine rollout does become extremely prolonged, but nevertheless, good economic conditions bodes well for consumer sentiment over the year ahead. Business confidence, so looking at the more corporate side of things now, over the past 15 months, business confidence has really closely aligned with trends in consumer confidence, have really mirrored each other. And the reasons for the fall and then rise are the same. There was the initial lockdown and sort of the economic shock, as we might call it, and then that's supported by the recovery and in particular, I guess, incentives on business investment, such as instant asset write-offs. That's had a particularly strong effect on private capital expenditure, which is expected to grow strongly to the tune of about 5% or 5% over the year ahead. That said, there's cause for confidence in many sectors at the moment, with favourable either demand, output, or price trends. We've seen agricultural confidence among agricultural firms surge as rainfall has improved, which has boosted production. Mining or commodity prices and property prices have been soaring. Demand for financial services has been recovering really well. Renovation activity has been buoying the construction sector, and retail sales, although tapering off a bit, do remain elevated compared with pre-COVID-19 results. So again, I guess pockets of the business sector, but more broad, that should expand to the more broader business sector over the year ahead, with mostly positive conditions a part of the forecast, albeit with a slight correction to business confidence for the same reasons as consumer confidence, just a bit of a correction after that, I guess, post-low bounce back. So let's get into the winners, likely winners and losers for the year ahead. To keep the news positive, in tourism, domestic expenditure on a monthly basis surpassed pre-pandemic totals for the first time in April 2021, which is, I'm sure, fantastic news for those involved in the sector. So from April 2019 to April 2021, comparing those months, there was a 7% growth in expenditure. And this occurred despite trip numbers being down by almost 10%. Expenditures up as per trip expenditure has increased significantly. Closed international borders, these are often, I guess, high value or high expenditure trips. And that expenditure has been sort of forced into the domestic market while the borders have remained closed. The downside is there has been significant losses over the past 15 months. The cumulative loss from domestic tourism alone since March 2020 is totaled at almost $39 billion, which is obviously significant. The growth of domestic tourism in 2020-22, so the financial year ahead, is forecast to be strong. Over the past financial year, trips to regional Australia have really taken up most of the growth, and that makes sense as many cities have faced ongoing lockdowns. Cities should recover over the year ahead, lockdowns pending, of course. That said, our regional and rural areas will continue to drive the overall growth of tourism over the year ahead. I've given the revenue growth of the domestic airlines industry as sort of a broad proxy for what can be expected in the domestic industry over the year ahead. And as you can see, 50% growth, again, a long way to come back from, but a positive result nonetheless. Just in the airlines industry specifically, Qantas has suggested Jetstar will operate at about 120% of pre-COVID capacity, while the Qantas brand goes at about 107%. So despite some increased capacity in the domestic market, demand should outpace that, with a slight rise in airfares likely over the year ahead. So some tourism adjacent industries. So I think for context, tourism is an important part of Australia's overall GDP picture, contributing about 3.5%, specifically 3.4% of GDP. But this sector has wide-reaching and flow-on effects to the rest of the economy. So what happens in tourism is important to other sectors. A boring economics term, tourism's economic multiplier is estimated to be nation leading at 1.81. What does that actually mean? So for every $1 spent directly on tourism services, 81 cents are spent in other industries. Just to clarify that, if you are, for instance, on a holiday and you spend money in a cafe or a pub, or you go to the sports game or go to an art museum, that is considered direct expenditure. The 81 cents is sort of the more flow-on effect thereafter. But that said, that still contributes about another 3% of GDP, of Australia's national GDP. The good news is, despite closed international borders, the share of overall tourism expenditure in Australia is about 3/4 domestic. So the strong recovery of domestic tourism bodes well. And not just for the tourism sector. So the table on the right outlines the total number of people employed by sector that rely either directly or indirectly on tourism activity. So it stands to reason that travel agencies almost or totally rely on tourism activity, and that sort of falls off as you get into accommodation, and then down further to, for instance, cafes, restaurants, pubs, clubs, and these sort of places. I guess there is a lot of reliance on tourism. I was personally surprised by the extent to which cafes and restaurants rely. So you're sort of in that 30% of total employment in those sectors rely on tourism. I believe that would be like from, I think, regional and rural locations and establishments which really rely at least not on tourism, at least visitors passing through country towns. I think we can contrast that more with retail trade, which, at 6% of total sector employment is significant, but there's a bit more of an element of international tourism, particularly high value and high spending international tourists spending in sectors such as, or subsectors such as luxury retail. Services industries, I won't spend a whole heap of time here, just as there's a few surprises and I guess brand new insights to provide. I think I just wanted to put this up to represent the scale of recovery that we can expect. So these are all lockdown affected industries, and as lockdowns, I guess, hopefully at least continually ease over the year ahead, these industries and sectors are set to grow really strongly. Employment obviously going to be a flow-on effect from that, in cinemas and airport operations leading the recovery in those areas. So agriculture, another likely winner for the year ahead, but also a winner of the previous year. Drought-breaking rainfall significantly aided Australian farmers last year. Crop output increased by almost 40%. So the graph on the right, and that's per Abaris, they have a bit of a reasonably strong decline forecast for the year ahead, but their modelling is slightly different to IBISWorld's, and because they tend to be a bit more pessimistic on rainfall totals. But that said, crop output is likely to remain high over the coming financial year. So we have water availability likely remaining, well, if not abundant, then at least pretty good, with on-farm dams, rivers, and other tributaries allowing, in particular, irrigating industries such as rice farming, cotton growing, fruit and nut tree growing to continue to perform well over the year ahead. Water availability also drops the price of water licenses in areas such as the Murray-Darling Basin where those are applicable. So sector profits should rise, and we should see that flow through to, for instance, investment in agricultural capital equipment. So benefits not just for the agricultural sector, but for those upstream industries as well. On the more consumer side of things, and what does that mean for the average shopper? The environment of reasonably priced, or perhaps even low priced fruit and vegetables should be a feature of the financial year ahead. On the livestock sector, meat prices rose last financial year as farmers undertook herd rebuilds. So several years of drought had forced many farmers to decrease their herd sizes, and after rainfall, in particular, improved pasture quality and reduced stock feed prices. There was sort of a national level, or particularly in drought-affected areas, a rebuild of herds, which constrained supply. But the year ahead bodes better for meat processors in particular. There should be an increase in supply flowing through these industries, and again, as that comes through to the retail level, there should be some pretty solid downward pressure on prices, and that may flow through to the supermarket sector as well. Losers for the year ahead, bit of a harsh term. A lot of these industries are just sort of facing mixed conditions, but in overall positive economic conditions, it is incumbent on me to pick a couple out that might not perform so well. So starting with residential construction, firms, I guess the good news is firms are set to benefit from the extension of the home builder program It's estimated to have prompted $30 billion worth of residential construction in the previous financial year, so the continuation of that program does bode well for the sector. As you can see on the graph on the right, dwelling commencement spiked, and that spike occurred in 2020-21 financial year. But the news for the year ahead is not so rosy. Dwelling commencements are forecast to decline strongly over the year ahead. Forward-looking measures such as dwelling approvals are pointing to a strong contraction in new residential property builds. That said, there's a silver lining in that renovation activity, which has been really strong over the past financial year, is likely to, that sort of strong demand in renovation activity is likely to continue into the year ahead. So I had hospitality on the winners list, as most of you will recall, but there is, I guess, cause to put this sector on the, I guess, quote unquote losers list as well. The news is good overall. I do wish to reiterate that, but the labour shortage facing the sector bears discussing. So the sector leads all comers in regard to businesses having difficulty finding suitable staff. And this has been, I guess, a feature of the Australian economy as we come out of the COVID-19 downturn. In particular, I guess, for the accommodation and food services sector in particular, this bears out in anecdotal and qualitative evidence. There's been a lot of news and media coverage reporting the strain that the international border closure has had on the hospitality sector workforce. From what I've read and what I can gather, restaurants appear to be hardest hit. I think particularly among chefs, those that work in, for instance, seasonal tourist locations that come in on working visas have been in particular shortage. So while hospitality is not the only sector struggling, given the state of the labour market right now, we can see that a lot of sectors are struggling to find suitable labour. The accommodation sector is really coming off a low base, so labour shortages pose, I guess, a threat to the sector, which was among the hardest hit by the COVID-19 pandemic. Homewares and liquor retailing, these sectors, I guess, and liquors in brackets, but the homewares retailing industries are likely to mostly decline over the financial year ahead. Obviously not an ideal result. However, these declines are more a return toward long-term averages and sort of falling off a high base, if you will. Revenue in most of these industries spiked during the COVID-19 pandemic. That trend's been pretty well covered. I won't double down there, but I guess that is to say for the year ahead, a return toward what will hopefully be normal out-of-the-house lifestyles and the mostly infrequent purchases of larger homeware items will cause sector demand to be sluggish over the year ahead and likely for a couple of years thereafter as well. I've included video games on the list as well. There was a big surge in demand for consoles last year, but that's expected to sort of moderate over the year ahead. Just quickly before we go, better news for the retail sector is that clothing and footwear industries are likely to expand. Supermarket and grocery stores, again, probably just a feature of being on the list because of, I guess, what we might call normalizing conditions. That said, there are some headwinds as well. So expenditures are expected to shift back towards food services industries as, broadly speaking, lockdown conditions ease, customer density limits are removed, and just generally Australians get out and about a bit more. In addition, we're also likely to see population growth, which I touched on earlier, over the year ahead. Again, net migration and population growth has been one of the key drivers of the industry's expansion over the past decade. Furthermore, we're probably going to see a slight uptick in price-based competition. We've seen that come through, I guess, in major players, so Coles and Woolworths advertising over the past few months. That's likely to accelerate further as Aldi is announced that they will enter the online grocery sales sector. Again, just some more price-based competition limiting revenue over the next year, but some better results, as you can see by that graph, on the 3 years thereafter. So I've got, I guess, a post-COVID-19 economy, but first, some commentary around that. But first off, I guess a commonly asked question we get here at IBISWorld is, well, I guess, what's the effect on lockdowns and how do these lockdowns, I guess, impact the broader economic picture? So I thought an interesting case study would be to use the Melbourne lockdowns of last year, and what can we gather from that? And what we can gather is that the effective lockdowns are pronounced. The second lockdown in Victoria, so sort of that September quarter last year, cost the Victorian economy $181 million per day. So once we sort of fast forward to almost today, including this little subsequent lockdowns we've had thereafter, the cumulative loss caused by the COVID-19 pandemic and lockdowns is, for just the state of Victoria alone, is estimated to be at 38 billion. So that is to say the Victorian economy would be $38 billion stronger had the COVID-19 pandemic never occurred. In quarterly terms, gross state product has been growing, growing strongly. However, that's on the graph on the right there. You can see in quarterly GP totals, state gross state product, has still not yet recovered to the expectations that we would have set prior to the COVID-19 pandemic. That is to say, there is still a bit of a handbrake on the Victorian economy. So lockdowns have remained a factor. That's the obvious. But other headwinds include customer density limits and lingering health concerns, particularly among, vulnerable Australians who have, rightful health concerns while COVID-19 is still bouncing around our society. So while the total economic cost over the past 15 months has been significant, it is worth noting that this decline would have been, much worse without a phenomenal amount of stimulus from both state and federal governments that have propped up the economy. As I touched on earlier, income support programs have been particularly beneficial in aiding the bounce back. So they don't have a lot of effect during lockdowns. It's more about getting that economy back to where it was as quickly as possible once lockdowns are eased. More of a state-by-state comparison now, and this table outlines gross state product, which is, just to clarify, a subset of gross domestic product. It's the same measure, just at the state level. So if I may, I'll draw your eye to the September 2020 quarter, and we can see the effect pretty starkly that Victoria's second wave had. A slight decline was reported in that quarter, but that was already after a significant decline in the June 2020 quarter, while at the same time, all other states and territories were reporting really solid growth. So to project this out now, what does this mean for, Victoria over the year ahead, but perhaps more appropriately, Sydney and New South Wales, as that state appears like it's going to go under, a more prolonged lockdown. In terms of exact percentages, it's of course pretty hard to estimate while the lockdown is ongoing, and we are not sure yet how long it will last. But as of now, and sort of looking forward a bit, a state-based contraction in New South Wales in terms of gross state product, a decline of about 3% can be expected. I've seen all the sources estimating the state's economic loss to be about $150 million per day. I think that bears out, as Victoria's was, $180 million a day, but that was a statewide lockdown, while the current lockdown in New South Wales is Greater Sydney, unless I've missed any news today. Similarly, the effect on lockdown will affect national GDP growth and the broader economic picture in Australia. Again, hard to estimate while lockdowns are ongoing, but early forecasts range from a 0.5% decline or 0.5% cut to 1% cut from projected GDP growth for the September quarter. I think overall, what's the outcome? IBISWorld does forecast national GDP to decline in the September quarter, just denting, what's been to this point a pretty broad and solid economic recovery. So there's been a bit of a debate around inflation. Inflation is pretty important. It's going to have a strong bearing on the Australian economy over the year ahead and the years thereafter. It's going to have particular effects on the cash rate and interest rates, and then the value of the Australian dollar. So recently I've seen a bit of pretty strong arguments for and against. I guess today I just wanted to sort of put the arguments forward and perhaps put in my 2 cents as well. So the cases for and against, I put them up on your screen just for you to digest. But again, both sides have compelling arguments. So for instance, supply chain disruptions and rent prices, they're the case for inflation. For instance, hot residential property market has been pushing up rents. And you can see the argument against that is rent prices. The rent prices were a decline and they've just bounced back over decline. With low migration, that'll curtail demand. Again, it's sort of two sides, the opposite sides of the argument there. So where do I personally sit on this issue? Supply chain disruptions and rent prices are particularly interesting in terms of the short-term inflation. But while we're looking at wages, consumption, and labour markets, which are sort of the bottom 3 dot points in each column, they're sort of more relevant to the medium term. But that said, I think there is a reasonable case for inflation to be strong over the short term. Expectations for the quarter just gone, for which results have not yet been released. It's pretty universally, seems to be or at least pretty strong consensus that inflation should grow. However, it seems to be, at least in my opinion, that this growth is likely to be a short-term factor rather than a lasting feature of the economy. So we've got factors such as increasing petrol prices and strong rent price growth. Again, these are likely short-term, and even if rent prices grow and that really strong price growth persists, we're likely to have this mostly offset by falls in the price of other items, namely utilities and food. I think there's other pockets of heat in terms of the domestic inflation market, namely used cars and inputs to construction industries. Again, unlikely to be long-term factors, especially as construction activity is likely to wane over the year ahead. So I think the other, argument that sort of get caught up in this is, inflation's rampant in the United States, and will this come to Australia? So there are some conditions that set us apart, which I think sort of lowers the risk of inflation for the Australian economy. Namely, inflation was not really has not been a feature of the Australian economy for nearly a decade. You can contrast this with the United States, which was reporting reasonably solid inflation before the COVID-19 pandemic emerged. In the US, in that period, they had a tighter labour market, which was boosting wages growth. So I think for inflation, it's really strongly tied to wages, and for wages growth to be, for sustained inflation growth, there needs to be sustained increases in wages. The points made on the left, I've just basically ripped off the Reserve Bank, and they've sort of outlined reasons as to why wages growth in Australia has been sluggish in recent years. Broadly speaking, these points boil down to proliferation of technology, which has sort of limited labour requirements, although while it's boosted wages in IT and technology-focused areas, it's largely suppressed wages in other sectors. And the other factor is there's been a lot of strong competition, particularly in goods markets, which has been discouraging cost increases among those firms, and those cost increases include wages. The short-term outlook for wages in Australia is pretty solid growth. We're likely to see unwinding of wage freezes implemented during the COVID-19 pandemic. That's the graph on the right. The 2 dot points are for, expectations and forecasts, and as we can see, wage freezes being largely unwound in Australia. Couple that with increasing hours worked, and the short-term growth in income in Australia should be reasonably solid. But for the longer-term picture, wages growth will likely be modest until unemployment falls below 4%. I've heard some arguments about that needs to be 3.5%. 4% seems, more likely. Interestingly, the federal government has forecast wages not to grow at all in real terms over the next 4 years. That's in their budget documents, and these documents seem to be optimistic, to use a nice term. That said, IBISWorld is more bullish. Public sector wage growth has tended to report pretty steady, modest but fairly steady increases, and that's been drawing up private sector wages. So with wage freezes being unwound, the prospect is reasonable for wages growth. The long-term forecast settles about around 1%, unless we see sort of any strong overhaul, particularly in the productivity space. 1% a year in real terms is not great, but it's not a complete disaster either. Lastly, I just want to touch on some of the changes that the COVID-19 pandemic has wrought on the way that businesses operate, in the way that we work these days. There's been a lot of talk about what it has implemented. To my eye, there are very few what we might call brand new trends arise. I'm not unique in making this point, but there has been an acceleration of existing trends, and that's happened across 3 key pillars. So the digitization, supply chain, and workforce. To my eye, the online retail scenario paints a really apt picture of how these trends have emerged and how they're likely to transpire moving forward. So online retail surged from 6.6% of total retail sector sales to peak at 11.1% and has since moderated back to now 9.2%. Again, that's sort of an element of permanency with the shift, but it's not like it's going to accelerate after the trend. So, for instance, as retail stores have reopened, some expenditure, but not all, has flown back into, I guess, store-based retail industries. In terms of how firms are likely to invest, cloud storage services industry is still forecast to grow quite strongly over the year ahead. So cloud storage services, there is going to be a bit more of a work from home that ties into the way, I guess, our workforce has changed. I'll touch on that in a second. But in terms of supply chain, I found it quite interesting that only 10% of Australian businesses have supported moderate to significant and lasting changes to the way that they, or I guess, to their sourcing practices. 25% have reported light changes. Again, I think sort of this business survey suggests that while there was sort of changes born out of necessity during the pandemic, not all of these changes are going to be carried on moving forward. Again, that sort of, I guess, element of a large change being partially moderated as we move forward. That said, in the retail space, for instance, automated fulfillment centers are becoming more common, and automation is likely to remain a theme of supply chains and, I guess, economies more broadly over the coming years. In terms of workforce, I just chucked this in. A US-based survey said 95% of workers are considering changing jobs. Probably not that high in Australia. The labour market here has not been, I guess, hot, if you like, as the United States. I guess, again, automation and e-commerce, it's accelerated, and that's created some job redundancies. 41 in the most recent survey, 41% of Australians are still working from home, at least partially. Again, that sort of will require businesses to continue to invest in their digital capabilities over the year ahead. But no, I guess it's not to say, like some people have been saying, that this is the death of the workplace. I think those calls are pretty overblown. Thank you, everyone. I hope you found at least some of that presentation insightful and interesting. If you have any questions, or just due to the format today, unfortunately, I can't take questions, but if you have any, please do talk with your client relationship manager. I'll be more than happy to provide or written responses when I'm able to. If you'd like a custom presentation tailored to your business, please, again, we have an IBIS Plus feature. Please talk to your CRM about that. All in all, thank you, everyone. Thanks for joining me today. Again, hope it was interesting and insightful. Stay safe and have a lovely Thursday afternoon. Thank you all. Bye.